Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at MacNicol and Associates Asset Management.
The reason why we really like music royalties as an asset is that fundamentally, there's no correlation. The correlation of the streaming numbers for artist ABC is not tied to the stock market, to credit spreads, to the risk-free rate. It's a completely independent activity profile that we can capitalize on.
Okay, well, welcome everyone. This is our regular podcast, and we've spoken to Michael Baker in the past, but we're really happy to have you here, Michael, and learn more about your side of alternative assets, which even that title, people sort of tune out going, the alternative? Okay, that's not for me. But we really need to get people to understand better what we're doing in the alternative space and your specialization amongst many within your firm, but the one that we're going to focus on today is music royalties. So maybe we'll just start with that, and maybe you just introduce yourself and just give us a little bit of background of who you are.
Sure. And thanks so much for having me. I'm excited to be back. I think it'll be a pretty interesting topic for some of your listeners that haven't heard from us in the past. And, I kind of joke with people all the time, for every bit as boring as the return profile can get here, the underlying assets are certainly interesting to talk about. Happy to be back. So yeah, as you mentioned, my name is Michael Baker. I'm one of the principals at ICM Asset Management, which is an alternative investment firm. Again, to your point, kind of a buzzword topic, but alternatives meaning anything that's not traditional publicly traded stocks, bonds, or cash. And so we're an alternatives firm that manages capital on behalf of wealth management practices, family offices, and institutional investors, and have been doing that for the last 20 years or so.
Great. Were you always drawn to the business side of alternatives, or any part of the creative side get you at all interested?
Sure. Well, yeah, there's always a notion of wanting to have interest in what you're doing. And I think that there's, I would probably best define our firm as interested in doing anything that is slightly differentiated or something that would require us to roll up our sleeves and add some level of active management to what we're touching. So we're not going to be the largest firm on the street, meaning we can't always compete in the most commoditized asset classes out there, but certainly something that we pride ourselves on is spotting trends in investment landscape and launching and managing product to give our clients exposure to something that would be considered maybe differentiated relative to what you can get from somebody else.
Okay. No, that sounds like a lot like us too, except for the product side. Do you have a personal connection to music, like a favorite artist or an era or a memory that's shaped your appreciation for it?
Well, both myself and many other members of my team, I would say, are big music fans. I listen to actually all types of music. Some of my favorite artists would be going back to kind of the punk era of the 90s when I grew up. So the Blink-182 type era, but even more iconic than that, U2, Coldplay, kind of some of these more classic rock into the 90s and 2000s would be kind of my sweet spot for music. But I really listen to everything across genres. I listen to rock, I listen to rap, I listen to country. I actually live out in Calgary, so it'd be criminal if I didn't. But yeah, certainly music is part of the DNA of myself and many other members of my firm.
Do you have music playing around the office, or do you try to keep things corporate that way?
We do have some music playing around the office. Yeah, we actually have a record player set up on right in the front when you walk in that typically cycles through albums, many of which we would be owners of. So that's pretty cool for clients and business partners of us to see.
Trying to picture that, like vinyl, like a record player, really?
Yeah, vinyl. Yeah.
Huh. Yeah. Okay. And how'd you first learn about music royalties as an asset class?
That's a pretty broad question, but I mean, I'm not sure that we necessarily discovered anything, because you have to remember that this entire ecosystem exists, right? So when we talk about our platform, we're paid in the exact same way that any other artist or creator would be paid in. So we're effectively tapping into some existing infrastructure. Maybe a better question would be, why did we identify this as an investable asset type? And it kind of we started looking at it in 2018. We ultimately launched the platform in 2020, but a lot of it has to do with some of the characteristics that I'm sure we will talk on today around cash flow stability and uncorrelated nature of cash flows. So when you look at it purely from an economics perspective, there's a pretty clear reason why this is a interesting asset class to be exploring. But yeah, we certainly looked at it for a couple of years before ultimately launching the platform in 2020.
Okay, that was my next question. 2020. This started in what year? Just the whole music royalties business. Just tell us a bit about those early days before your firm got involved.
So the early days would probably be, well, actually, maybe what we'll do here is let me share my screen and I'll show you a little bit about kind of where the music industry came from and where it is today. And then maybe we'll jump back and we'll talk on how things are monetized today, right?
Great.
So if I skip forward, what you're looking at here is a revenue chart for the music industry as a whole. And there's kind of two key trends that you should narrow in on when looking at this chart. One would be that dating back to the 2000s and into the probably as recently as 2010, you had an industry that was effectively dominated by physical music sales, meaning if you were an artist, if you were a songwriter, the only way for you to monetize your work would be that you would have to sell CDs. And as a consumer, the only way to consume that music would be you have to go to the store and purchase the CD. So this gray line here was representative of kind of the total revenues in 2000. And you can see that absent a couple of rounding error lines that you can't even make out on the bar chart, 100% of the revenues were around physical sales of music. And then what happened is that the music industry actually went through a bit of a bear market. And you might remember this era, David, but as time progressed, people wanted the convenience of being able to listen to music, but the guardrails weren't necessarily set up to protect artists and creators from what ultimately became theft. So there was this huge era of piracy and torrenting where the consumer basically said, well, hey, like I have access to any song ever created. I can illegally download it online and have it at my fingertips. Why would I ever buy a CD again? So for a number of years, the industry was in a bit of a tough position. And then ultimately, Spotify was the first of the now many streaming platforms to launch. That happened in the early 2010s. And we're quick to forget that changed everything. I mean, not only is music now back to being in a full-scale bull market as represented by total revenue growth, but you can see that this green line, which represents streaming revenue, continues to make up more and more of the pie as well. So we're quickly diverging on a path where the kind of the fingertip consumption of music across streaming platforms, social media, radio, etc. Anything that would be considered on demand is quickly driving music revenues to all-time highs, which kind of takes us to where we are today. So I made a comment at the start that we monetize our business the same way that any other artist and creator does. And that's basically as a result of just tapping into the existing infrastructure.
Okay. And that green performance rights, total streaming, I'm looking at the wrong green. That's been growing the most rapidly out of anything. Have their payouts to artists changed much, or how has that worked? And follow up to that is, are these artists being treated better than ever, or is it still tough days for them?
The short answer is yes, artists are now being treated better than ever. I think that if you were to ask that same question in 2014, you might get a little bit of a different answer. And I think that maybe that was some resistance on the part of the artist to kind of change the existing business model. I think they were kind of seeing, well, my things are being stolen from me. My work is being stolen from me by the torrenting and the illegal downloading. And the model, it wasn't clear that the streaming model was going to be to the benefit of the artists and creators. the way that it is now. So let's skip back and I'll give you a bit of a overview on kind of how this industry works. And of course, I'm going to try to simplify this as much as I can, but there's basically two sides of this value chain. You have the owners of the rights, which would be defined as artists, creators, financial owners of the assets, such as ourselves. And then you have the platforms. And the platforms are what generate the revenue that benefit the rights holders. So a very dumbed down way to think about how these two ecosystems coexist is that for every dollar that's generated by the platforms, so think about the $12 a month that you might pay for a Spotify subscription or an Apple subscription or a Amazon Music subscription, for every 10 or for every dollar you pay into that ecosystem, the platforms themselves will keep about 30% and flow 70% of it down to the underlying value chain. So the fundamental principle of why this is an investable asset class now is that there are laws, and the laws state that music has to be licensed, right? So consuming music illegally is exactly that. It's illegal. Consuming music properly requires revenue, right? So it's a paid service, whether that be ad-supported revenue, whether that be subscription service revenue, or tangent revenue that comes from sync licensing with video games or connected fitness platforms like Peloton or social media platforms like TikTok or Facebook or you name it, right? If you're hearing music, whoever owns that underlying intellectual property is being paid a royalty for its use. So what that means is that you've got all these different artists, creators, songwriters that all own what are called catalogs. Catalog is effectively a fancy term for a collection of underlying songs. They would all own these catalogs that would be potential acquisition targets for us.
Okay. Well, then let's just before we get into who the artists are that you're working with and so forth, just maybe jump to the slide that just shows how this works financially, what the payout is, and what investors should expect.
And just to be clear, are you asking about the chart that kind of mechanically walks through the payment flows, or is it more
just what the end user, the end investor will hopefully see?
Okay. Great. Is this what you're talking about here?
Yeah, and then you can just update everybody for 2025.
Sure. Yeah, I mean, the return profile of the assets that we're acquiring are largely dictated on the multiple that you pay to acquire them, right? So maybe even before we talk about return profile, it would be helpful to kind of give your listeners a little bit of an overview on kind of how we look at these assets from a financial point of view.
Okay.
And while there's really no rhyme or reason between any of these different catalog acquisitions that we've done, you can see by our kind of sample list of artists that we've acquired, the only commonality between these acquisitions is that they look reasonably similar from a cash flow point of view. And what I mean by that is that our fund targets catalogs that would be considered older in nature, and to us, older means more predictable. And the artists have to be reasonably iconic, meaning the staying power or the listenership power of the artist has to be reasonably present. So if you look at this is kind of how a consumption curve on a music asset would look. And what we're not interested in doing is buying anything that would be considered viral or not iconic. And the reason is that it might look something similar to this red line here, where you've got a decay curve on the consumption that's far too steep. From our perspective, we are looking to deliver cash flow stability to our investors. And the easiest way to do that would be to acquire assets that have stable cash flows. And by buying things that are slightly older in nature, so if you look at our portfolio construction, we really own a rounding error that would be considered new. And the vast majority of our portfolio would be at least 5 years old. 10 years is even better. 15 years is even better. 20 is even better. And the reason is that you have more historical consumption data to be able to have higher conviction in the multiple that you're paying to acquire the asset, if that makes sense. So
excellent. Thank you.
Yeah. So from a return profile perspective, I mean, we're looking to deliver something that looks like a mid to high single digit yield and maybe as high as a very low double digit total return. But that's largely going to be driven by our ability to acquire good assets at reasonably attractive prices.
Okay. And so your long-term average is sort of low double-digit returns for people. And, how stable is that? What happens if there's some kind of a market down cycle or credit crisis or some kind of a shock to public equities? How will that affect your business?
The short answer is that it doesn't. And I think this is a really interesting topic to dive into because in many cases, you've got the alternative investment space that is targeting and acquiring assets that are reasonably correlated to the overall business cycle or the overall economy or the credit markets or the risk-free rate, right? And I find that an interesting paradox because you've got, a publicly traded and a privately traded peer for both the assets, if that makes sense, right? So, if you look at real estate or infrastructure, right, like you might have instances where private vehicles offer lower correlation, but the underlying assets themselves still might have reasonable correlation to something like a business cycle, right? The reason why we really like music royalties as an asset is that fundamentally there's no correlation, right? The correlation of the streaming numbers for artist ABC is not tied to the stock market, to credit spreads, to the risk-free rate. It's a completely independent activity profile that we can capitalize on. So from a correlation perspective, like there really is none.
Yeah, that's excellent. That's why we all like them. And much safer than a bond, in my opinion, and not subject to sort of interest rate risk and economic risk to a certain degree. You saw where the market slowed up a bit during the credit crisis, but that was really probably the whole system going through change and really turning into more of a business than the way it used to be structured as a physical business. Let's just keep moving on here. So let's go over some of the artists that you have in your catalog, and and even some of the latest acquisitions and what we can expect to notice around the Christmas season with any artists that you have.
Sure. So maybe I'll pull back up that slide that I had before, and I think the one thing that we are pretty focused on is not anchoring to any artists. So we show something like this purely to show that we want to provide diversification, right? I think that from an investor perspective, everybody likes to talk about, what deals have you done recently or which artists have you acquired assets from? And I understand the rationale there, but in my view, the best way that we can drive the most consistent forward-looking returns is to own everything. Right? You want to own so many artists across so many different titles, across so many different listenership trends that no one trend in the way that people consume music derails the cash flow profile. So we by owning everything or being exposed to everything, I should say, you effectively become beta. And we believe in the long-term growth trends of music as an underlying asset class. So our view is really, we don't want to be underwriting talent. We want to be underwriting cash flows. And that's part of the reason if you were to look at our portfolio today, you'd see 6,000 different pieces of underlying intellectual property, as opposed to maybe a style that you might find in equity portfolios that would be more concentrated in nature, right?
Okay. And I sort of laid you up to talk about one artist that's not on this older list here, Mariah Carey. Maybe just explain what's going to be happening over this Christmas season.
Well, I'm sure it's already happening because and this is probably a good example of why you want to own so much at the same time, is that, different genres might have different nuances or cyclicalities to their listenership profile. So, I mean, one of the deals that we did earlier this year was we acquired All I Want for Christmas Is You by Mariah Carey, which many of your listeners would know as probably the most iconic Christmas song of all time. And it's one that gets played, probably starting this week, and then come January 1st, really gets played nothing at all. So you're going to have different trends like that. And these things even exist on a genre basis, right? So anecdotally, if you think about something like country gets a ton of radio play. Something like hip hop gets almost no radio play due to the, suggestive nature of the lyrics and, swear words that would be embedded into the lyrics. So things like that. There's just little nuances related to all these different genres, which again, our view is by doing many, 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 many high quality acquisitions spread across many, 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 many different genres and many, many, many different artists. It allows us to participate in beta. And going back to this chart, there's basically three main reasons why this trend continues and why the streaming growth continues. So we're okay being beta because we believe the cash flows will continue to grow over time. And there's three main reasons that that's going to happen. One is that more people will be streaming music in the future. So if you think about the global population, there's less than 1 billion people in the world right now that are paying to stream music, and there's 7 billion people in the world. So that gap continues to close, right? Spotify, Apple, Amazon, these major corporations have huge breadth of their distribution, and they will continue to unlock new customers in new markets. So that's one, right? Second reason why this trend continues is that the number of platforms will continue to grow. So the real advantage that we have, again, going back to this chart, these are sample platforms that pay us. But if we were to look at the exhaustive list of all of the platforms that pay royalties because they have music embedded into their platform, it's very long and it continues to grow. And so by being at the bottom of the value chain and just owning the underlying asset, we will benefit from new platforms that launch, and then effectively insulated from any growth profile of any one of these platforms, right? So from our view, like, we're champions of these platforms because they generate the revenue for us. But do we really care whether Spotify takes market share from Apple, or if Apple takes market share from Amazon, or if people move from Instagram to TikTok? And the answer is no, because all of these platforms embed music and we get paid regardless, right? And then the third and final point, which I'll highlight here, which I think is probably the most important, is that the price to consume music will be higher tomorrow than it is today. And so there's a massive inflationary hedge built into these assets, because you're going to continue to get those emails like you do periodically. It says, "Hey, David, thanks for your loyalty. The Apple Music subscription that you used to pay $12 for now costs $13.49. And the data shows that you're not going to do anything about it." So there's pricing power embedded into these platforms because of the data that they have, the playlists that you use, right? You're so integrated with their system that they continue to raise pricing, very similar to what you saw play out with video, right? With video streaming. So you're going to see that continue to play out in the music space. And because we work on a revenue split model, higher revenue by the total platforms means higher revenue or higher cash flows to our underlying assets.
And just making me think now, like, who acts as the police in this whole system? Like, I go to a sporting event, I hear music playing. Like, am I just to assume that 100% of that's being paid for? Or depending on the venue or the bar or whatever, they might be just, playing it off of one of these streaming services, and no one's getting paid in that public forum. Like, who polices it?
Yeah. So there is still a bit of a policing exercise that goes on. Now, both the payment tracking, the payment facilitation, and ultimately major owners of these assets tends to be one of the big three, or some company that's owned by one of the big three. So the other thing that's great about this asset class is that it's a bit of an oligopoly, right? You have Sony, you have Universal, and you have Warner. And the three of those companies effectively control the show in terms of music. So I'm not going to sit here and tell you that every single dive bar in the world is properly licensing music. But if you're talking about something like a football game, for example, like they are. But the trends, there's two trends that that while there is still whatever you want to call it, leakage that happens in the system right now, the trends are that the leakage is glide pathing to zero. And the trend is that the payment delay is trending towards zero, meaning that the time that it takes for you to stream a song on Spotify that we own to the cash hitting our bank account is continuing to narrow. So those are basically long-term trends that are going to continue. But again, the nice part here, David, is that we are not doing anything outside of what already exists, right? We are paid in the exact same way as every artist and every creator. We're paid by the same counterparties on the same dates, at the same times, at the same prescribed rates. So this is a pretty institutionalized asset class now, and there are people that are on the case, is the short way I can answer your question. Yeah.
Good one. Well, let's just wrap up here. Is there anything else that you think we should go over from the slide deck for the audience that they might be asking or wondering about before I just ask a few final questions?
No, I think we touched on a lot of them. I'm trying to see here. We did talk about the uncorrelated nature. Maybe the two things that I would highlight here that would be maybe a little bit interesting is that these are effectively perpetuity assets, meaning once you acquire them, we're actually entitled to receive the royalty revenues for the life of that artist plus an additional 70 years. 0. So for all economics purposes, these are perpetuity assets. The longevity or the duration of these assets is super appealing to us. And this might be very different from other royalty-based investments that you might hear about, like a horizontal well or a pharma royalty, where typically there's either a steep decay curve or a reversion clause to the acquisition that you've made, where your cash flows go to zero significantly earlier than ours would. So we like the fact that we own the asset. We like the fact that the cash flows grow, and we like the fact that we can basically model it as a perpetuity asset. And the other piece that we didn't touch on, which would be the second one that I would make sure that your viewers are aware of, is that music royalties are not capital intensive assets, meaning unlike other, call it real asset categories, such as real estate or infrastructure, which might have similarities in the sense that they produce cash flow, the obvious difference is that there's incremental capital costs that sit in between your revenues and your cash flows. Whereas because these are digital assets, they're significantly easier to model than a physical asset, in the sense that once we've acquired the asset, that asset will continue to generate cash flow, not require us to invest any additional dollars in equity over the life of ownership. Right. So you effectively own an asset where your revenues equal your cash flow.
That's excellent. Well, I'm really pleased with it. So just finishing up with maybe some quick fire wrap up questions what you can maybe tell us about yourself, just to summarize. So favorite concert you ever been to?
Oh, I mean, you're going to make me repeat the answer I already gave you, but
yeah,
Coldplay is my all-time favorite artist. So I've been to Coldplay a couple of times. I think they're pretty, one of the things that I really like about Coldplay is that every genre, or every, I should say, age demographic tends to be there. I mean, if you go to a Coldplay concert, you find that there's 18-year-olds that know all the lyrics of the new works, and you've got 60-year-olds that are singing along with some of their original albums. Artists like Coldplay, artists like U2, I mean, you have to just respect the longevity that they've had across decades and decades of producing music. Coldplay, and I would see them again 10 more times if I could.
And maybe the same answer, but one artist you'd love to meet.
Sure, I'll go with same answer. Yeah,
same answer. Okay,
Chris Martin. Yeah.
And this one probably isn't fair because you've answered it that you'd want to own just about every streaming song in that sort of that bandwidth that you talked about. But if there's one royalty to one song that you'd like to own that perhaps the fund does not own yet, what would that be?
Well, I think we would like to continue to move into different genres. So we've got a pretty good representation across like the major genres. You've got the pop and the rock and the hip hop and the country and the electronic. Got a few deals in Latin. Latin is one of the fastest growing music categories. So we'll probably continue to look at doing more there. But just purely from a diversification standpoint, David, I think it would make sense for us to continue to explore some of those maybe emerging music asset classes that might I put air quotes emerging because it might seem emerging living in North America, but globally, bit of the opposite. So you've got, Bollywood, you've got K-pop, you've got, these different sub-asset classes within music that are enormous globally, but are probably underrepresented in North America. So we'd like to do more of those. The challenge, of course, is that most of this deal flow comes from the US, where they've got the most sophisticated legal entertainment law firms, business managers, labels are typically situated in Nashville, LA, or New York, which is where most of our deal flow comes from. And doing a K-pop acquisition, for example, would typically require you to do that deal maybe outside of Canada. So there's little nuances that make things a little bit more challenging, but anything that would provide diversification to the platform relative to where it is today would be something we're interested in doing.
Okay, this has been great. Well, thanks for doing this again with us. And I just wanted to have the opportunity to go through this with you personally, and something that we plan to share with our audience, and even try to attract some more eyeballs for both of our businesses. So really appreciate this, and I'm going to stop the recording and we'll just say our goodbyes.
Thanks, David. Appreciate it.
Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit MacNicolasset.com to learn more.